Hi, I'm Michelle Filipenko, and today we're here with Scott Robbins.
Hi, Michelle.
Hi, Scott.
Thanks for having me.
Yeah, thanks for being here. So today we're talking about mortgages and how you can use your mortgage or your equity in your home to build some wealth. What are some advantages of using the equity in your home? Of using that equity to invest, and what's the difference between, say, using a line of credit versus using a variable rate?
Okay, so of course when you're leveraging to get in the market, you're borrowing one way or the other to get your investment working, getting more money in the market right now, right? So you have more time for it to grow.
Yes.
And when you're using a line of credit, typically these lines of credit are based on, their interest rate is based on prime. So it can be prime plus a half or prime plus 1%. And so you're paying this interest. It's a great arrangement in some ways because you only have to pay the interest.
Right.
You don't have to pay down the loan. So it doesn't take a lot of your cash flow to get a lot of money in the market.
Right.
And what I wanted to compare to that is if you do have some home equity, you can do a few things that still allow you to follow the same strategy, but allow you to use your home equity to reduce your costs and pay down your debt. So it's really easy to do this if we use some really basic numbers here. So let's use an amount of $100,000. And if you had $100,000 and you borrowed on a line of credit at, say, 4%, then over a year, and this is roughly speaking, about $4,000 in cost, in interest cost, right? Now, if you were doing the same thing but using, say, a variable rate mortgage secured by your house, now you use some home equity to do that, but a variable rate mortgage, your rates on those right now are going to be between prime minus 0.6 and prime minus 0.8, depending which your qualifications and which lender you're with and that kind of thing. But you're saving yourself quite a bit there in interest. So if you use the same amount, say $100,000, but let's say you acquire a variable rate mortgage, and let's even be more conservative. Let's say prime minus a half.
Okay.
Nice easy number to use. So over the year, you'd pay about $2,500 in interest versus $4,000.
Right. So the interest is lower.
Less interest, yeah. So by using your home's equity, you're going to save yourself, $1,500 right? And every little bit counts when you're using these strategies.
Right.
Now the other difference is, of course, when you're saying that line of credit, you have to only pay the interest. Because when you set up a mortgage, you can spread that over, 30 years, and when you do that, you have to pay back the principal as you go. So when you compare these numbers, you have a monthly payment that pays off some of your loan every month with the mortgage. The line of credit, you just pay the interest. End of the year, you still own $100,000. If you use the mortgage, then every payment you make will be slightly higher because some of it goes to principal and some goes to interest. On $100,000, I think it's $20 or $30 difference in payment, but almost half of that payment is actually going to reducing your debt. So at the end of the year, you've paid less interest, and you may have the out-of-pocket slightly more, but you're more than compensated for that by the amount of the debt that's paid down. Right? So you paid down that $100,000 to a lower amount. So your position at the end of the year is, if you use a line of credit, you've paid $4,000 interest, you have $100,000 debt, and your investments have grown to wherever they've grown. Assuming the same amount of growth in your investments, using the variable rate mortgage, you will have paid slightly more, but your debt load will have come down. And you've paid less interest.
So either you can pay less up front every month, or you pay a little bit more, but you're paying down the loan. So when it comes time to, look at how your investments are, some of that loan is paid off, so there's going to be more really sitting in your investments in terms of growth and the amount you paid off. Yeah,
because in the end, when you sell these investments, you have to pay off that debt either way, and the difference there is your profit, really, right? So both really good strategies to get in the market right away and give your money more time to grow. One can save you a bit of interest, but of course you do need home equity to do that, right? Whereas the investment line of credit has the advantages of being accessible to people without all.
That's true. They do the principal and interest with line of credit as well, but there are some advantages too.
Yeah, you're mostly your interest rate then, right? Like I think with the line of credit, you're free to pay more if you want, right? Yeah. So it's just a matter of which way you want to go about things, right?
Yeah. And there's certainly some advantages, like you're saying, with using a mortgage to do a leveraged investment. So That's great.
Yeah, so those are really the main details. I mean, the other things is that with a mortgage, you can really set it up for a specific amount of time. So
Right, so 30 years down the road, or
if you're
20
planning
years
a
down
long-term
the road?
strategy, right?
okay, this is when
Yeah.
we're looking to have this much paid down and
Yeah.
that kind of thing. So so it also sort of works as a planning tool.
Yeah, so
well.
say you're retiring in 20 years and you want to get some money in the market, but you have a house with some equity.
Yeah.
Set up a 20-year mortgage,
Uh-huh.
and you know the mortgage will be paid
Uh-huh.
in 20 years.
Right.
You just keep on making your payments and watching your investments grow.
Right.
With the line of credit, you really have to enforce your own willpower to pay it off. Which is good or bad, depending who you are, I think. Yeah.
Well, there's definitely some great advantages with using a mortgage. So the most important thing you can do is sit down and talk with a mortgage broker and see what kind of strategies would work for you for using your equity in your home as a way to invest and plan and save some money there and watch it grow. So thank you for coming down, Scott.
Thanks for having me, Michelle.
It's great to have
Thanks
you
for
here.
watching us.
Yeah, thanks for watching us. Talk to you soon.